Hey everybody, Matt from 90th percentile.ca here. For access to more study notes, practice questions, mock exams, and end of chapter question videos, visit 90th percentile.ca and sign up for your free trial today. Link below in the description. All right, financial reporting quality. This module is really qualitative in nature, which is a nice break from some of the calculations we've been doing in the last couple modules. Key two topics here. We're going to be discussing the difference between earnings quality and financial reporting quality. There's a visual slash framework that the curriculum uses, which we're going to go over pretty quickly. And we'll also be discussing the different characteristics of earnings quality versus financial reporting quality because they are different. And then really the bulk of this module is talking about aggressive versus conservative accounting assumptions. And we'll be going over some examples where firms are making different assumptions related to their accounts receivable, accounts payable, depreciation expenses, maybe some other expenses, and revenue recognition. Key thing to note is that, in most cases, barring like very extreme assumptions, all the assumptions that are made here are, for the most part, allowed under the accounting standards, right? So there is some bias inherent in all financial reports, in my opinion. Um, so we're trying to find, or be able to recognize a good balance between aggressive and conservative assumptions. And we'll also go over, like I said, some examples and we'll identify whether what the company is doing is aggressive or conservative and what that implies for how their financials look in the current period and future periods. So let's jump into the questions. All right, so the curriculum uses this nice visual here, um, basically to distinguish between earnings quality and financial reporting quality. Use some key terminology here. The framework is, pretty qualitative in nature, but I thought I would go over it really quickly. So we have the very far end of the spectrum here, which is good financial reporting quality, so the information is decision useful, and the earnings quality is high because it has sustainable returns and adequate returns. So returns that are adequate enough to provide a good enough return to shareholders after meeting all the company's obligations. And then coming down the spectrum, we have decision useful financial reporting and maybe not so sustainable earnings. And then coming down the list, this is where it just starts to get related to financial reporting, where we have some biased accounting choices. So, makes analyst life a little bit difficult, a little bit more difficult when they're looking at financial statements. And then going even further down, we have some earnings management. So this is, when companies take either conservative or aggressive stances in their financial reporting and accounting assumptions, used to, either smooth earnings or make earnings look better than they are, stuff like that. And then at the very, very end of the spectrum hit down here, we have non-compliant accounting, so they're just, not even following the rules. And at the very, very end, we have fictitious transactions, which are essentially fraud. So now that we went over that, we can just look at some questions really quick. Low earnings quality most likely reflect low financial reporting quality. Nope, this is like they're considered two separate things. Lower earnings quality most likely reflects company activities which are unsustainable. Yes, this is it. And then you can even see in C, once again, they're talking about information that does not faithfully represent company activity. So this is, once again, related to financial reporting. Next, earnings that result from non-recurring activities most likely indicate, well, it's going to be lower quality earnings again, right? So uh, non-recurring activities typically less sustainable. Obviously depends on the business, but in general, they're less sustainable. And then here again, we're talking financial reporting in these two answers, so not relevant. Next, which attribute of financial reports would most likely be evaluated as optimal in the financial reporting spectrum? Um, so conservative accounting choices, this is related more to like bias choices here. Could even be down here in earnings management, depending on how aggressive they are. And here we have sustainable and adequate returns, which is, yep, right up here at the very top with, once again, good earnings quality and then hopefully some decision useful accounting assumptions, which makes the financial reporting quality high as well. And then at the very end of the spectrum, the lowest level of quality is fictitious transactions. Here we're talking about aggressive versus conservative accounting, and this is related to the underlying assumptions that are taken in financial reports and the bias that can go into some assumptions. Put really simply, aggressive assumptions increase um, your financial position. So it could be, making your balance sheet look better, making your revenue look better, net income, whatever, just makes your everything look better in the current period. So the key here is the current period under review, right? So conservative would make your performance look worse in the current period. So you could do something like um, smoothing out earnings a little bit. Well, not necessarily smoothing out earnings, but let's just say in year one, the company makes their revenue look worse, right? So this would be conservative. And they do that because maybe they're deferring revenue or something, some funky stuff going on. And they're doing that because in year two and year three, they can make their revenue look better. So this year one would be conservative, and then year two and three would be aggressive. So it can be a combination, but when these questions are asking about aggressive versus conservative, just note that they're worried about the current period. It's really important, or else you're gonna get mixed up. So coming to the questions, if a particular accounting choice is considered aggressive in nature, then the financial performance for the reporting period would most likely, well, we just went over this, exhibit an upward bias, so look better. And then next, which of the following is most likely to reflect conservative accounting choices? Decreased reported earnings in later periods. Once again, we're worried about current periods. B, increased reported earnings in the period under review. Nope, conservative, make it look worse. And last, increased debt reported on the balance sheet at the end of the current period. Yes, because this would, make it seem like the company's more levered, more debt on the books. Not always a good thing. And then finally, which of the following is most likely to be considered a potential benefit of accounting conservatism? A reduction in litigation costs. Uh, yeah, we'll come back to this. This is kind of on the fence. It's going to be our answer, but we'll come back to it because once again, we're worried about most likely. Um, B, less biased financial reporting. No, like being conservative is inherently a bias, right? So the bias is still there. And the last one, an increase in current period performance. No, so this would be aggressive, right? So this is the answer. The most likely benefit of accounting conservatism is a reduction in litigation costs. I mean, they're kind of stretching a bit here, in my opinion. I guess what they're getting at is, you know, making your performance look worse won't be as won't be faced with as much backlash from analysts as if or versus like making your performance look really good with aggressive accounting, even though it's not true. Um, Once again, kind of stretching a little bit here because you can also argue that being like in this example here, right, we're being conservative in early years to be aggressive in later years, but like maybe here and here you might have problems with litigation, but here you won't. So I mean, kind of a weird one, but we'll just move on. Companies experiencing a period of strong financial performance in order to increase the likelihood of exceeding analysts' earnings forecast in the next reporting period. So keyword next. The company would most likely undertake accounting choices for the period under review. So we need to do something now that makes us look better later, right? So you got to be really careful with the wording here because you could easily get mixed up with these answers. So what would they most likely do? Would they inflate reported revenue? No, because that'll be, you know, reported now, but we need to make ourselves look better later. And would we delay expense recognition? No, because then we would have more expenses later, so that wouldn't be good either. we would actually accelerate expense recognition because we would have more expenses now, um, or essentially shifting expenses from the later period to today, so that our later period, like next quarter or whatever, looks better. So gotta be careful with the wording here because if you didn't see the next, then you're gonna choose one of these. If a company uses a non-GAAP financial measure in an SEC filing, then the company must A, give more prominence to the non-GAAP measure. If it is used in earnings releases, no, you can't, you know, place more emphasis or divert eyeballs to the non-GAAP measure. You have to actually do B, which is provide a reconciliation of the non-GAAP measure and equivalent GAAP measure. So I kind of touched on this in a previous module, but like recently, over the last, call it 3-4 years, there's been a lot of like high growth tech stocks that have been reporting some weird things like, I don't know, sometimes they call it adjusted EBITDA, sometimes they call it like normalized EBITDA, which is kind of weird. Like this is usually in M&A, this terminology, but it is what it is. And here they would add back a bunch of expenses that they say are non-recurring, just to make their adjusted EBITDA look a lot higher. So they might be reporting like 400 mil in adjusted EBITDA by adding back like 200 mil of expenses, like maybe you know like employee comp plans and stock options and stuff like that, which they say is not recurring, but like it really is if those employees are still on. But um, it's kind of some of those bias choices that we've been talking about, right? So they can report whatever they want. Like they can report adjusted EBITDA of, you know, just add back every single expense if they really wanted to. But at the end of the day, they're going to have to provide a reconciliation to normal EBITDA. And they're going to have to, show the line by line how their adjusted EBITDA reconciles to maybe their normal EBITDA of like 200 mil or something like that. And the reason this is even allowed, I guess, is because inside like, I was kind of being extreme, but for some companies, some adjustments are relevant, and at the end of the day, they're trying to present their financial reports in a way that best reflects the economic reality of the company. So in some cases, it's actually useful, but when it's all said and done, we need to have some standardization in financial reporting, so they can report whatever they want, but they have to reconcile to normal EBITDA. Last couple here. A company wishing to increase earnings in the reporting period may choose to, so we're worried about the current period. Uh, so A, decrease the useful life of depreciable assets. No, this would actually increase their depreciation expense. So like if we had, a PP&E of 1,000 and we wanted to divide it over like a 5-year useful life, say this was standard, it would be 200 depreciation per year. But if we did the 1,000 over a shorter useful life, so 4 years, then we would have a 250 depreciation expense, which would drive our net income down. B, so once again, we're looking at increase earnings. Lower estimates of uncollectible accounts receivables. Yeah, this is actually the answer, because when you increase or when you write off any accounts receivable, it's assumed to be bad debt. So customers owe you money, but maybe they gone bankrupt or something. They're not like you're not going to get your money even though you provided a service, product or service. So when you write down your AR, let's say your AR is 1,000, you write it down to like 750, you're gonna have to recognize a $250 expense on your income statement. So if you lower the estimate of uncollectible accounts receivables, let's say you say the AR is only like it's 1,000 on the books, but you're only gonna lose 150 of it. So only 150 is uncollectible, then you would only have to expense the 150 as opposed to the 250, which would increase your net income. And then finally, which technique most likely increases the cash flow provided by operations? A, stretching the accounts payable credit period. Yeah, this is the answer. So recall that, when we do our cash from ops section of the statement of cash flows, you start with net income, and then we add back depreciation, and then we add, well, plus minus any change in working capital, and an increase in a liability is an increase in cash, right? Like the easiest example I always think of is when you increase debt, like you issue debt, you're getting that cash, right? Like you're getting a loan, so you increase your liability and increase your cash. But accounts payable is the exact same thing. Um, or if you're stretching your accounts payable period, so instead of paying your suppliers in 60 days, you're paying it in 90 days now, you're going to accrue more accounts payable, which would increase your liability, which increases your cash.